Hello, this is Gary Dugan at the Global CI office, and it's the 2nd of February, and another exciting week in the markets. But I'm also going to give you some reflections on how we've seen since the beginning of the year, with some dynamic returns in the equity market and even bonds that have been rock solid. So let me start with sharing my Bloomberg screen so we can just take in the performance of equity markets in the year to date. So if you look to the far right there, year to date, which includes how these currencies have done versus the dollar, sees an outstanding number towards the top there at 17.5% from the Brazilian equity market. Another very strong performance. And even with the sell-off that we saw at the end of last week in the commodity markets, this market still stood tall. Going down that column, again, another dynamic performance from the Cosby, continuous structural change going on there, both in the economy, but of course within the corporate sector. And we've also seen elements of that in the Taiwan market as well, up 8.7. But globally, right to the bottom here, we can see that markets are still giving us solid returns, although they're not the most dynamic at an aggregate level of just 2.5%. But if you analyze that number, we'll be well into double digits for the year. But the laggard has been the US equity market, which, although that's where most of the macro news has been since the beginning of the year, the S&P 500 up only 1.4%. Indeed, even though Europe has been relatively lackluster compared with the strong returns at the end of last year, at 3.8%, the Euro Stoxx well outperforming the S&P. If we now turn to bond markets, some interesting returns here. I mean, went into the year worrying that 10-year yields could end up going higher, and indeed that has been the experience. But if you look at those year-to-date returns at 0.9 for global aggregate, again, if you annualize it, you're in double digits. But we're still getting good returns at the shorter end of duration, around about a 1% return for global aggregate, which includes all of the global bond markets in the higher grade area. And in the emerging market debt, right at the bottom there, a quieter return than we had last year at just plus 0.36, but still a good return. And in global high yield, where there's been a lot of skepticism that this sector can continue to perform, again, a close to 1% increase in the middle of your page there. We also last week, though, saw signs that maybe at times the markets are getting too carried away. And I say that when we look at, and I'm going to start with silver, which had such a strong correction last week, down almost 30%. And that was partly because there was a huge amount of money that went in earlier in the week and then jumped out as the market tipped down. So you can see here that through the 26th through to the 30th, we'd seen the silver price push from just below $100 well through up towards 120. And then as trading has started in Asia this morning, we're seeing the market now pricing at around about 80, 83. And maybe we're finding a low point at the 80s. But you can see that, again, it looks like investors are traveling around the world trying to find places to put their money away from the previous leaders in the US equity market and in technology. And just going to the gold price, which has been a little bit more of a less exaggerated moves than in the silver market. Again, we've seen some profit taking. But again, I caution that I wouldn't be jumping out here. This is still an asset class that people want as security against problems going elsewhere. Although we're getting some volatility in the near term, really when we went above 5,000 so quickly, it was probably exaggeration to say that that was just going to keep barreling on without some volatility here. But maybe like the silver price this morning, we're finding a low point that we're going to find some dynamic buying. Just want to return, though, to the technology sector and just give you some indication that if things don't go quite to plan, we can see some significant corrections. And we saw this in Microsoft last week, where the results disappointed the market. And all of a sudden, we saw quite a marked setback. So over a couple of trading sessions, the price came down from 480 to 430, so well over a 10% correction. And you can see there that since August of last year, Microsoft has not been pushing ahead on all engines, in fact, has been moving sideways to down. And this is where the story is just kind of petering out. Yes, there's still a lot of good news. Indeed, if you look at the capital investment going into AI in 2026, I think we're now looking at an increase of close to 40% year on year. So those numbers of investment in the sector are still very strong. But people are just worried that some of these companies in the very near term are not matching the kind of revenue growth that had been anticipated before. Let's just switch now to just a bit of the economics and particularly the Fed. The Fed meeting last week was not a surprise because there was no change in terms of the direction that's been given to the market about rate cuts. And just to kind of, again, using the Bloomberg here, the bar chart at the bottom there just shows you the degree to which the market's pricing rate cuts. So on the right-hand scale there, you see -2, but that -2, those two rate cuts are still not priced until the very end of next year. Now, we now have a clear idea of who's going to be leading or likely to be leading the Fed. Kevin Warsh, who's seen as a kind of what's called middle of the road kind of character. So there wasn't very much repricing of the markets last week on the back of that news. Now, in terms of data this week, a lot of focus, as is every month, on the employment data. And towards the end of the week, we're going to get initial jobless claims and payroll numbers. So in terms of the payrolls, the number that the market is most focused on, we're looking for a change in payrolls of around a drop of an increase of 75,000, but the unemployment rate staying rock solid at 4.4%. So no significant change there. Last week, there was a bit of disappointment around consumer confidence numbers. That's a couple of data points that we'd had through the course of the week. So the course of the last few months, just showing that we are seeing some maybe just a hesitancy in the US economy and the consumer sector, although quite frankly, still not come through in terms of the numbers. Indeed, as we turn from January into February, the news is that growth generally around the world is rock solid. There have been some upgrades to GDP forecasts. And in terms of central bankers, more of a mixed bag. It's not going to be a year where every central bank is cutting interest rates. Indeed, we think from the Reserve Bank of Australia, in New Zealand, and in Japan, we could see rate increases as we go through the next few months. This week in the UK, maybe an outside chance of a rate cut, and maybe even the ECB in time thinking about a rate cut. But it will still be a focus on the Fed. Can we get those two rate cuts earlier? But I think they can only come if we see a remarkable slowdown in the US economy. At the moment, there's no significant signs that there's any recession risk out there. It's just rock solid. Hence, good returns from the market still. I'd be a bit more wary in the bond market, where we still believe that there's some risk in high yield towards the back end of this year. But broadly, steady as we go. Thank you.